So, without further ado, we've got a small disclaimer on the front of the screen. You just need to bear this in mind, that the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Your individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or Raymond James or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. That's our beautiful office in Macclesfield. And so today we are going to be covering bounce back loans. I just want a quick update on those, the self-employment income support scheme, discretionary grant top-up, and then the main event of this morning is a presentation by Rob Ullman from Raymond James Wilmslow, covering the global macro and market update. And then, as I say, towards the end of the session, hopefully we'll have some opportunity for some questions and answers. So, bounce back loans, you've probably read a lot about this in the press so far, but the scheme actually went live on Monday, and you are entitled to actually borrow from £2,000 up to £50,000, or a cap of 25% of your business turnover. The loans are 100% government backed, but that doesn't mean you don't get out of repaying it if anything goes wrong. You are still, the borrower is still liable for 100% of the debt. It's only if you cannot repay it, and the government will then step in and repay the banks. Interest rates have been set very low. The interest rate is set at 2.5%, and the interest for the first 12 months is paid by the government, and you should get a capital repayment holiday for the first 12 months. So effectively, you've got absolutely nothing to pay for the first 12 months. The loans are over 6 years, so first year you pay nothing. If you borrow the maximum of £50,000, you then have 5 years to repay the remaining £50,000 at £10,000 a year, plus some interest. And there's no guarantee fees, there's no early redemption penalties, and so on. So in a way, it's a bit of a given. You could take this money, and if you didn't need it, you could then repay that money back at the end of 12 months without any penalties. There's been a huge take-up in this with this loans. You can make an online application through your bank. It's a 2-page form, and you go to your existing lender. The only eligibility criteria, as you must be a UK business and it must be established by 1st of March 2020. You've just got to confirm that you've been adversely impacted by coronavirus, and you've got to confirm you're currently not using the CBILS loan scheme. You can't use CBILS and use the bounce back loan scheme. However, if you've borrowed below 50,000 under the CBILS, you can ask to be converted to a bounce back loan. You just got to confirm you're not in bankruptcy, liquidation, or undergoing any debt restructuring. So fairly straightforward criteria for most people, and so well worth having a look at if you do have shorter cash. I know on one of our previous webinars we always mentioned that cash is king, and I think this gives you the opportunity to have some borrowing at a low rate. Yes, you have to remember that you've got to be able to afford the repayments, but at the moment, if it's available, then it's certainly worth looking at. Let's have a look at self-employment income support scheme. There's been a lot about this in the press recently. However, the portal is now available and you can check your eligibility. At the moment, there is an online eligibility checker, and you can put your details in there to see whether you are eligible, and then they will tell you when you can start to make your claim. The claim, we can't, as Harts, unfortunately, make the claim for you. You actually have to make the claim yourself. However, we can help you with this, and if you want us to see whether you're eligible or not, we can put your details through the checker. You then get your own government gateway code, which you then have to use to apply for your support. So just bear that one in mind. The eligibility checker isn't infallible. We've had 1 or 2 issues with it already. So for instance, if you've actually don't meet the criteria, it doesn't pick it up because you may have ceased in business as a self-employed person and converted to a limited company. Unfortunately, the checker doesn't pick that up, so we just need to be careful of that. And then we have the latest help from the government in relation to this discretionary grant top-up. and it's basically a fund available to small businesses with under 50 employees who has suffered as a result of the coronavirus outbreak. And it's basically aimed at businesses that may have had to say shared spaces, regular market traders, small charity properties that would meet criteria for small business rates relief, maybe bed and breakfast businesses that pay council tax rather than business rates. You actually have to apply to your local authority for this grant, and it's a discretionary amount payable by your local authority. There's 3 levels of grant payments. The maximum is £25,000, but there will also be grants of £10,000, and the local authorities will have the discretion to make payments of any amount under £10,000. But it's up to the local council to adapt their approach to the actual circumstances. So again, you have to apply to the local authority for that. That's pretty much it on our general update. I'm now going to hand over to Rob Allman from Raymond James, and I'm going to make him the presenter so he can then carry on with this presentation. So it's over to you, Rob. You've now been made the presenter, and hopefully we'll have some questions at the end.
Thanks, Stephen. Stephen, can you hear me?
Yes, we can hear you.
Great. And can you see the screen?
We can see the screen.
Okay, fantastic. Thanks, Stephen. So I thought it'd be a good idea to run through some sort of global macro and market update themes. It's been a very volatile time, obviously, in market, so some of the numbers are pretty extreme. Just to give a quick introduction on myself, just let me switch slide. So my name's Robert Allman. I run an independent advice business based in Wilmslow. We offer independent financial advice to high net worth clients and families. I've been in finance for 15 years plus. I used to be at Barclays Private Bank, sitting on their UK investment committee, and now obviously run my own business. What I wanted to do on the first slide is just give a summary of all the major indices globally, because I think it's very interesting in terms of how various markets have performed, because there has been some fairly wide dispersion. Obviously, when it became apparent that the crisis was going to cause major lockdowns in, say, sort of mid-February, you see on this graph, markets were ticking along okay. Markets, to be fair, were relatively expensive, so coming from fairly high valuations, and you can see then the collapse. I mean, to take the US as an example, they recorded a record high on the 12th of February, and they fell by over a third in the following weeks, which were some of the fastest pullbacks in most previous recessions and crises. You can see, interestingly, the grey line shows China, which just didn't fall as much. They obviously went into this first, depending on how much you believe their figures, they got it under control quite quickly, but generally markets have been quite impressed with how they've dealt with it, and therefore they didn't fall as much, and they are coming back on stream in terms of their economy. So they are pretty much flat year to date, which some people find fairly surprising. If you look at the US, I'm going to talk a fair bit about, because we are a global investment manager and we invest more in the US than we do, say, in the UK. Also, they tend to dominate global markets because they're the biggest market. The US is the red line, and they did have some fairly major falls early on, as I say, over about a third, but they have bounced back pretty hard. So some of their tech sectors are up year to date. Healthcare is about flat, but you can see there the US is not that majorly down since the bounce back in April, and we'll talk through some of the reasons why and where we think that's sustainable. Unfortunately for us as UK based people, and I know quite a lot of investors in the UK can still be quite UK centric in their investments. The UK fell pretty hard, along with Europe being the orange line. These are the top largest companies in the UK and Europe, and they haven't bounced back as much. And we'll talk a bit about some of the reasons for that. I think Europe and the UK have a lot more sort of value companies, a lot more in oil and financial services companies. The US obviously has a lot more tech exposure that dominates their market, which has helped them. We've all, I'm sure, been buying a lot more through Amazon and using Netflix and various other things. And unfortunately for us as UK-based people, they are all based in the US. If I flick over to the next slide, there have been some crazy numbers coming through, and more will come for Q2 in the upcoming months. But one I thought I'd mention, because it's been fairly prominent in the press, has been the oil price. Oil price went negative a couple of weeks ago, which was the first time I think that had ever happened, certainly the first time in my lifetime. And it was caused by various things. Obviously, demand for oil has fallen back quite considerably as lockdown has happened globally, and supply has continued fairly strongly as various OPEC and Russia, etc., were struggling to agree cuts. But the big thing, which is a bit of a technicality on how oil's traded, but effectively all the storage capacity for oil pretty much maxed out a couple of weeks ago in America. So you probably had some very scared young traders in America worried that they were going to receive millions of barrels of oil to their desk, and therefore they were paying people to take those oil contracts off their hands, and therefore they were paying quite a lot of money to get that oil stored. So that was a fairly extreme event, which has been caused obviously by COVID-19 and the repercussions on the markets. If you look briefly on bottom left, it just goes into a bit more detail on the variance in economies, with the S&P 500 showing in April it's bounced back harder than all the other major indices. So it's up 13% for April. Year to date, it's still down about 10, but you'll see China's about flat. And unfortunately, UK is still down a good 20-odd%, not too dissimilar to Italy. On the right of this slide, you will see some chat on fixed income. It's worth noting, I'll talk a bit more about it, but the benefits of diversification. The reality is that the things that really did well were UK government debt and US government debt. There was a flight to safety, and you can see they have had very strong returns. But if you're in sort of more investment grade, so companies or lending to smaller companies and high yield companies, they were also suffered losses. Another asset class worth mentioning is gold. You know, gold has performed quite well for a variety of reasons. If you switch to the next slide, so I thought it was worth mentioning because it is pretty interesting, because it is fairly unprecedented. And you know, I went through the financial crisis, which seemed fairly bad, but these numbers that we're going to be seeing in terms of GDP and other things and unemployment data are going to look worse. So far, this is the US, and effectively we can fairly confidently say that the recession has started now. You know, Q1 was negative in the US, had a number of minus 4.8% annualized, and the expectation is Q2 will be a lot worse, with sort of annualized drops of about 30-ish%. There is, the positive is there are expectations in the markets and that there will be a major bounce back. But to put some of the other numbers in perspective, there's been roughly 30 million increase in unemployed in the US over the last 6 weeks, and this is also taken into account all the support measures that have been brought in to help. and this is therefore expectations of unemployment in the US are getting to around 17%. I think in the UK they're expecting up to 10% plus, and this is the highest since 1948. So the numbers will dwarf the financial crisis, but the reality right now is there's still views that because there hasn't been contagion in the banks and various other areas, that will hopefully bounce out of this pretty strongly later in the year. So the next slide, bit more data in terms of bankruptcies for the states. The bankruptcies are looking like they're going to be the second highest since this data started in early 2000 for 2020. Auto sales in the US, there have been a record low since data started for that in 1976. So some of the data and some of the numbers out there are brutal and unseen numbers. Some of the better things holding up obviously are things like food. Food purchases have jumped a fair bit. Obviously, we all need to continue to eat, and home maintenance spending and things like that. It did initially drop, but that's starting to pick up as well. Next slide just gives you a bit of information on the Eurozone, and there was some data out for the UK this morning. Bank of England, and take all projections with a big pinch of salt at the moment. Analysts and economists are at the best of the time struggle to predict the future, and at the moment the numbers are even more variable. But what everyone does know, the numbers are going to be looking bad. The Bank of England saying for the UK they're expecting a 14% drop in GDP for 2020. They think that's the worst GDP drop in a year since a recession in 1706. And I had to look that up, and it was partly a Spanish war and a great frost across Europe. But they do expect a bounce back in 2021 of about 15%. In Europe, it's similar. Europe GDP is down about 3.8% for the first quarter. Now, just to bear that in mind with the US, that's not annualized, so that's a worse number than the US. The US's GDP has fallen less so far. They went into lockdown after, and they are seemingly trying to come out of lockdown relatively sooner than Europe, so their GDP numbers aren't looking as bad as Europe and the UK, which is another reason potentially why those areas have underperformed. If we switch to slide 8, this just shows a bit of data on April. I thought this would be useful because it shows the difference in the various different sectors in terms of the benefits of diversifying. Again, the energy sector on the right shows that it has bounced back very hard in April by about 30%, but it's still down about 35%. This compares with technology stocks in the US, which are up again now for this year. Healthcare obviously has also done pretty well. It also gives you a reason for, it's very hard to time these things. You know, in March, obviously it was one of the worst monthly falls in the US and across the world in terms of global markets, and it was a time where people were pretty fearful, and I was talking to clients and you know, a couple were quite worried that things would only get worse. That normally is the worst time ever to buy, and it's shown again in this instance where April is now the best month for the US market since 1987. You know, when you normally have a big pullback, you can find you get into oversold conditions and things bounce back quickly. If I look at slide 9, I'll quickly run through this one, but the main slide I think on the right is due to this bounce back. If you look at the actual price of stocks, this is especially to the US because the US has bounced back much more than everyone else, but the actual price to the forward earnings of a lot of companies in the US, because the earnings numbers have gone down a lot in terms of projections, they are not cheap now in the US. The bounce back has been substantial, and they're looking about as expensive as they were in, you know, the .com bubble. So there's a lot of value out there in the UK, Europe, and in some parts of the US, but the actual major market, because of the tech companies and others, and because of earning downgrades, they aren't cheap anymore post this April bounce. Why is this happening? So this slide just talks to you about the extent of the fiscal and monetary measures. I'm focusing on the US. The UK's done similar in terms of scale. Europe struggled because they're having problems obviously agreeing the scale of bailouts. Germany, for example, have very different views to what they need compared to Italy, and that's causing them some difficulty, and they haven't signed off major purchases, major treasury purchases, which help ease the markets. The US, for example, though, if you look at the Fed and what they've been purchasing treasuries, effectively creating money and increasing their balance sheet to help cost of funds for companies out there. In the last 10 or so years from the financial crisis, the max that they were ever buying was $120 billion per month, which sounds like a big number. Over the past 5 weeks, they've averaged over $50 billion per day. So on a monthly basis, that's over $1.5 trillion a month. So the scale, as on the graph, is at least a multiple of 10 in terms of the support that they are giving. So it's huge, and that has really helped markets. And there's a saying that don't fight the Fed in terms of traders, because if the Fed's pumping money into the system, that has also really helped the economies. Generally, people believe this is the right thing to do, but it will have consequences for the future. The other part of it is, the question of, is this, the end of the beginning in terms of the virus and in terms of the lockdowns? You can see this is across Europe. Most are starting to reduce lockdown measures, opening smaller businesses, etc., opening parks. The UK, for us guys, fingers crossed, it sounds like it might start on Monday. They might start opening up certain businesses and parks and things like that. So there is hope that things are starting to ease and open up, and the markets aren't pricing in potentially future other spikes, which would cause another drop potentially in the markets. The other point worth mentioning is that there's a lot of data on viral drugs. There's a lot of tests being done everywhere. There's one that's been signed off in the US now, which has seems to have some benefits in terms of reducing deaths and reducing the length of time people stay in hospitals. That's helped, but they aren't magic bullets at all. There's also hope on vaccines coming in by the end of autumn, hopefully, or not. But again, there are no guarantees of this. But this has given markets a hope that potentially the worst case scenario is not going to be seen. I'll quickly move on because we're running out of time, I think. But quick thoughts for the future. The problem is going to be how we're going to deal with all this debt once all this thing hopefully is over with and we're all back to normal, which may be a good few months from here. There is going to be a lot of debt sitting in lots of governments. Will this cause governments to allow inflation to happen? Will all the money pumped into the system cause inflation? In the short term, we're having deflationary pressures. I think you'll probably see some negative deflation numbers in the States and other countries. But the medium to long term, there are worries of inflation. So in portfolios, you may think about ways of hedging that, whether through inflation-linked bonds or gold and things like that. The other way they could deal with it is tax people more. But it will be interesting if there'll be support for that. Some other worries, obviously, escalation in trade tensions. I hope that countries don't become more segmented due to this crisis. I think Trump is likely to escalate and ramp up trade tensions with China coming up into the US election. So that seems quite likely, which will cause more volatility. And the other part is, do we see issues with Europe again due to them struggling to agree measures on this? The point though, and often I read various much better investors than I and businessmen than I, in terms of people like Warren Buffett and a guy called Ray Dalio in the States. And some of their thoughts are, in reality, the greatest strength of the human population is our adaptability and ingenuity. We tend to always get through these major problems. They do happen from time to time, every 10 years or so, or very major ones every 50 years or so. And we adapt and we power through it. And that's what drives productivity, our ingenuity. That's what really drives GDP over time. And that's what drives stock prices and various other things. So on a long-term basis, and as Warren Buffett just said a few days ago on his AGM, you will make over long periods of time the best returns in equities, but don't let your emotions drive the decisions that you make, and and also make sure you've got a long time horizon to do that. But we will, as previous crises, always come through this, and it will look like a blip on a long-term graph in the future. Final thing, quick thoughts for individual savers. Diversification, I bash on about this to people all the time, and it's been shown as a lesson once again. The reality is diversify, irrespective of how high conviction you have in something. Even the great investors still diversify, and you should diversify in asset classes, countries, sectors, currencies, etc. That's very important. The other major thing out there in terms of economics and the biggest power out there is compounding. The sooner you start investing, the easier it is, because compounding is an amazing force. And if you start investing when you're younger, so don't worry about where markets are as much. It doesn't really matter. Compounding will make those returns a lot larger over 10, 20, 30 years or so. It's a good time, I think, as well at the moment to do a financial health check. Great time to sort of look through your financial affairs, see if you're in order to when you're planning on retiring or anything else, or planning for your family. The usual things should always be looked at first. Things like pensions, ISAs, JISAs, things that the government give you freebies effectively. Lots of tax-free growth. Pensions, we've been doing a lot of maximising people's pensions coming into the tax year end, and doing people's ISAs and JISAs for children, etc. Financial advice is very personal, so it's very different and bespoke to each client. But if you have any questions on any of that, or want to have a review of something, you then obviously just get in touch. And that's about it for me, I think. Hopefully that did it in the time.
Yep, that's great.
Stephen?
That's very good indeed. Thank you very much indeed. I'm just going to make myself presenter again. So
that was a bit of a whistle-stop tour, so I hope it wasn't too quick. But there's a lot of sort of crazy numbers out there, I suppose, I wanted to cover.
There are some numbers that look quite frightening and quite horrifying in the short term. We've just got to hope that in the long term things quieten down a little bit.
I think that's it, and I think the difference in this potential crisis is there is an expectation that things will come back on stream very quickly. So the numbers look horrific, but the markets haven't reflected it that badly compared to the GDP numbers, because they're expecting a sort of flip switch back on, so it's just a short-term thing, but we'll see.
Great, thanks very much indeed. We've got a couple of questions that are in the chat box. For the bounce back loan, there is a limit of 25% of your annual turnover. I think I did mention that. But how does it apply to new startup companies with no established turnover? Well, according to the regulations, the scheme is actually open to most UK businesses regardless of turnover, because it's a self-declaration form they have to complete. So they have to meet the eligibility criteria. You have to be in business from March 2020. So if you've got some turnover prior to that, I believe you should be able to apply. But again, it will all depend on your bank at the end of the day whether they will accept that. Next question we've got is in relation to the discretionary grant. Is it an additional grant to the original 10k rate relief payment? Not really. It's a discretionary fund has been set up to accommodate the small businesses that were previously outside the scope of the business grant fund scheme. So I wouldn't expect that you'll be able to claim under that scheme. It's designed to cover businesses will maybe rent offices where they pay one fixed fee for the rent, the rates, the heating, the lighting, and so on. A serviced office potentially, and they can apply for some rates refund or grant for that particular office. Those were the couple of questions that we had so far. If anybody wants to unmute themselves and just come forward with a question, that's fine. Next one is, are there any plans for the government to subsidise dividend income in a similar way to payroll as part of the furlough scheme? At the moment, we've not had any inkling that that's going to happen. Unfortunately not. Originally, we did think that it might have done, but it doesn't look like that's actually going to happen. Having successfully applied and received £25,000 from the Bounce Back Loan Scheme, could I go back and ask for more if required? I believe as long as you're still meeting the criteria, I believe that you still can. But we can always come back to you on that one, Simon, if need be. Any other questions that people want to raise? No, that's great. Well, all it remains to say is thank you very much for Rob for that very informative, if a little bit terrifying scenarios as we are at the moment. And again, if you need any help from him, his details are up on the screen. If you need any help from Harts, we are, as I said previously, still open. We're open for business. We are practicing social distancing in the office, and with plenty of our team working from home remotely. If you need any help with any of the bounce back loans application, Sybil's loans application, obtaining the self-employed grant, or any other of the government support that's out there, please feel free to give us a call. We are here to help you. Thank you very much for joining us this morning. The recording will be up on the Harts Limited YouTube channel later on. Have a great bank holiday weekend and enjoy the sun. Thank you very much indeed.
Thank you. Cheers, Stephen.